Welcome to Beyond the Benefits. My name is Colleen Patterson, and I'm the Vice President of Compliance and Employer Services here at Savoy. And I'm excited today because I have joining me one of my colleagues, that is Sara Simkins. And Sara is a Senior Employer Services Specialist specializing in ERISA services. How are you doing, Sara?
Doing very well, Colleen. It's the beginning of a new year. It's a very exciting time. And of course, that means we have some new things coming out.
We sure do. And it's funny that you say it's the beginning of a new year because what has happened is there was some last minute changes that got in under the wire at the end of 2024. And that's really what we're going to be talking about today. So when I'm saying the end of 2024, it really was something that occurred on December 23rd, 2024. And what had happened was there were two bills that were passed and then signed by President Biden. And the first bill was the Employer Reporting Improvement Act, and the second was the Paperwork Burden Reduction Act. Now, before we talk a little bit about what each of those two things are, I just wanted to take a minute and just kind of remind everybody, so how did we even get here where we are today to even talk about these things? So under the Affordable Care Act, we're talking about really the employer shared responsibility provisions, and they apply to what we all know and love as applicable large employers or ALEs, and they have to do certain things based on the rules of the employer share responsibility under the ACA. They have to offer a certain amount of coverage. They have to make the offer of that coverage, and it has to be affordable at a particular price at a particular time. So it's been quite a burden for employers for the last 10 plus years to be able to comply with something like this. So there's been a lot of discussion over the years about what can we do to make things easier for plan sponsors, not only with just to comply, but also for the second piece of employer shared responsibility, which is all the paperwork side of it. And that, of course, is the reporting. So that is how we got here to where we are, which is talking about these two new bills. So, Sara, I know you spend an inordinate amount of time on this, and I know you love it, which is great. So how about you tell us a little bit about the Paperwork Burden Reduction Act?
You've got me pinned, Colleen. I absolutely love this stuff. So let's get into it because I love talking about it. So when it comes to the Paperwork Burden Reduction Act, what it really is it something that eases reporting for employers on the federal level, at least, by removing the requirement to deliver 1095 forms to employees automatically. Instead, employers are considered to be complying with the 1095 distribution rules under the ACA if they provide clear, conspicuous, and an accessible notice for forthcoming instructions from the IRS that recipients may request a copy of their 1095, and upon receipt of request for a 1095, they must provide the statement to the recipient by the latter of January 31st of the year following the calendar year for which the return was generated. So what that really means is for January 31st of 2025, that's your date for 2024 1095-C forms, or for 30 days after the request is received. These new rules apply for the current round of filings and going forward. However, of course, we are awaiting further guidance on the actual contents and timing of such a notice statement, so stay tuned for that. There is some previous guidance we can refer to, however, regarding the 1095-B distribution under prior rules, but it's unclear whether ALEs or applicable large employers can rely on that guidance relative to avoiding distribution of the 1095-C. Under the alternate rules for 1095-B notice distribution, a provider must post a clear and conspicuous notice on its website that includes a statement on its main page reading tax information, which links to a secondary page which states in capital letters, I'm going to have a quote here, important health coverage tax documents. Again, that's all in capital letters. It explains how responsible individuals can request a copy of the appropriate forms, and it includes the provider's email address, mailing address, and telephone number. Presumably, similar rules would apply for 1095-C notices, but of course they haven't been released yet, so we are hoping for further guidance to come out soon. It's very important to note here, however, that this does not remove the employer's obligation to mail the 1095s to employees who reside in New Jersey under the New Jersey state reporting regulations. And I think that's something that's really important to stress here is that while we love the new Employer Reporting Improvement Act and Paperwork Burden Reduction Act, they unfortunately will not impact state filing regulations. These merely impact federal filing regulations. So, those New Jersey state regulations, which apply to any employer who hires a resident of New Jersey or an employer whose dependent resides in New Jersey, you're still going to need to comply with that mailing requirement. This also does not impact the employer's requirements to report to the IRS by March 31st of 2025 if they are a self-insured, level-funded, or applicable large employer. So again, you still have to report to the IRS. You still have to adhere to state reporting regulations. It just eases some of that federal distribution requirement that employers have to adhere to. And finally, I always think it's so important to stress as a reminder, an applicable large employer or ALE is any employer or collective group of employers affiliated under Section 414 of the IRS Code who have, on average, 50 or more full-time and full-time equivalent employees in the previous calendar year. So I know that's a lot, but let's move on to the Employer Reporting Improvement Act. What can you tell us about that, Colleen?
Thanks, Sara. And as I said in the beginning, this is like one of the things Sara loves the most. So she's always so articulate with it. So thanks for going over the information for us. So I'm going to spend just a couple of minutes talking about the Employer Reporting Improvement Act. So all of the information that Sara was going over with the Paperwork Reduction Act, it's really narrowly targeted, meaning it's, of course, very specific. There's a contrast, though, to the Employer Reporting Improvement Act. And the reason for that is because the modifications really are broader, although they may even be less welcome, honestly. So let me just go over a couple of topics here under the Employer Reporting Improvement Act. So the first one is it has to do with taxpayer identification number reporting. So historically, the ACA forms, they were generally required to disclose each covered person's social security number, or of course, their tax identification number, or the TIN. So the new law allows ALEs to substitute a birth date in instances where an SSN or a TIN is not available. So this provision of the law codifies existing IRS practices that's already kind of been happening. So I wanted to point this out because the reason I'm saying this is a little bit broader is because it certainly affects a larger population. So when you think about what you've had to do in the past to be able to try 3 times, you have to document that to get this information. Now they're saying that it's okay to substitute a birth date in instances where the SSN or the TIN isn't available. So that is some welcome news there. The second area under the Employer Reporting Improvement Act has to do with the letter 226J. So when you hear the words 220 or the word and the numbers, letter 226J, what that means is that somebody has received an intent to have a penalty assessed due to non-compliance of the employer share responsibility provision. But what the Employer Reporting Improvement Act did is it actually had an impact on the response time to those 226J letters. So ALEs now have 90 days to respond to employer shared responsibility penalty notices, or again, those letter 226Js. Now, before it was only 30 days, and that was pretty tough. I mean, Sara, you and I have worked on countless ones where by the time the letter gets to the right person within an organization, 3 weeks could have passed by because no one's really sure who handles something like this. So it's some added relief to be able to see it go from 30 days to 90 days so that ALEs have ample time to be able to get their response in. But this also means that it should really result in things like fewer extension requests, which was happening, all the time. And it also hopefully will have a better output as far as ALEs actually responding to the letters timely, where they're not going back and saying, oh my goodness, I didn't realize I missed the first one. And now I got a second one. And now it's, hair on fire. How do I respond? What do I do? And everybody's scrambling and they're still not even quite sure why. So this added extension of response time should be some great relief for ALEs that do find themselves facing a 226J letter, which is an employer share responsibility penalty notice. So the next area for the Employer Reporting Improvement Act that we want to touch on really has to do with statute of limitations. So what this is about is the law establishes a 6-year statute of limitations on the IRS for returns that are due after December 31st, 2024. That has to do with assessing employer shared responsibility payments. And this is something that definitely is welcome for ALEs and certainly for those of us that help ALEs with these types of issues, because previously there was no statute of limitations. So the IRS could go back as far as they deemed necessary due to noncompliance. And now this new provision that's under the Employer Reporting Improvement Act puts a limitation on that. So that's definitely some welcome relief for sure. So the last item that I wanted to talk about today is the electronic delivery. So what this has to do with is ALEs may furnish any requested ACA forms to individuals electronically, provided such individual has consented to and not revoked their consent to electronic delivery. So this is the old, you got to tell them what you're going to do. You have to tell them where they have to go to retrieve that information, and they have to accept that that is the delivery method. And assuming that all of that occurs, then the forms can be provided to individuals electronically as opposed to via paper. So it's an important step in the process. It is some welcome relief that does have an impact on the ALE's relationship with their reporting vendor, because it certainly could have an impact on cost, but then it has an impact on the delivery responsibilities too, meaning there isn't a need to ensure that it gets out on paper because it would be going out electronically upon request. So we've gone over a lot of information here. So what are the action items and the takeaways for ALEs? So Sara, from the items that you had covered, what is it that ALEs really want to pay attention to?
So first, I think it's important for ALEs to make sure that their benefits team is familiar with the new rules and that they understand these specific changes and how they impact an employer's specific reporting obligations. So that means really familiarizing yourself with the new legislation. Also, it's important to implement notice requirements. That means that plan sponsors will want to take advantage of the reporting relief, prepare, and make available the required notice by January 31st of 2025. And we are expecting to see more guidance on the exact format of this notice. However, we should ensure that the notice is clear, conspicuous, and accessible, providing all the necessary contact information for employees to request a copy of the form. Also, employers should update their own internal processes. That means adjusting their internal processes to align with new reporting allowances that, for example, permit the use of birth dates instead of social security numbers or tax ID numbers when you're unable to locate those numbers for a covered individual or their dependent. Colleen, can you point out a couple other things employers should think about?
Sure. So I think one of the most important takeaways, too, in addition to what you're talking about, Sara, is really to monitor compliance. So what these ALEs want to do is they want to ensure that they keep an eye out for that IRS 226J letter, or honestly any other related follow-up notices from the IRS that they may be getting, because they want to ensure that they respond within the required 90 days or they request an extension. So if you're currently working on a response to a 226J letter, consider contacting the IRS to confirm. They will automatically extend the response deadline to 90 days. Never hurts to ask, because the answer is always no unless you do. So make sure you reach out. And then lastly, I think the last item is just to obtain consent for the electronic disclosure. You can't send it electronically unless you have the consent to do so. So plan sponsors that already do or wish to furnish ACA and other employee benefit documentations electronically, they want to confirm that they have valid consent in place, or they want to work through the process to obtain the required consent from those employees. So it could be a little bit challenging, but it's not without its benefits of doing so, no pun intended. Just make sure that you follow the IRS, Department of Labor, and the U.S. Department of Health and Human Services rules to ensure compliance with electronic disclosure and the consent for obtaining that. All right, so that's going to wrap things up for Sara and I today on this episode of Beyond the Benefits. Thank you so much for joining us for today's topic, and be sure to check out the rest of our videos on our YouTube channel, as well as our SoundCloud and our website. Thank you.